Now, this consolidation, I will go ahead and read it. And now I read. Adani acquired 80% of the ordinary share capital of Kenya Airways for 160 million and 40% of the ordinary share capital of KPLC for 70 million on 1st of January 2017, when the retained earnings balances were 64 million in Kenya Airways and 24 million in KPLC. Adani, Kenya Airways, and KPLC are public limited companies. That is also very important. That is very important. Then, the statements of financial position of the three companies as at 31st of December 2019 are as set out below. So guys, you can see we have provided there the statements of financial positions for Adani, Kenya Airways, and KPLC. This is just the normal balance sheet or the statement of financial position given for each. We have PPE for the non-current assets investments. Current assets are there. There are only two. Share capital is there. Share premium, retained earnings, then current liabilities. We do not have long-term liabilities there. Then let's look at the additional information. On 30th November 2019, Adani sold some goods to Kenya Airways for cash 32 million. These goods had originally cost 22 million and none had been sold by the year end. On the same date, Adani also sold goods to KPLC for cash 22 million. These goods originally cost 10 million and KPLC had sold half by the year end. Now, even before I continue reading these additional informations, members, I want us to get this approach. It will help you in exam to save on time and to maximize on your marks, because that is the most important thing that you need to remember. Now, whenever you get such a question, very fast, you need to know very well, go to the required part and see what is the examiner looking for here. Prepare a consolidated statement of financial position for Adani and its subsidiary as at 31st December 2019. And you incorporate the associate in accordance with IAS 28. So you can see what the examiner wants you to do. And the examiner has even gone ahead and told you that this one is Adani Group and its subsidiary. Now, I want us to remember very fast and know that when you are consolidating a financial statement, if it is the income statement, you know that you need to prorate it according to the period that the group existed. But when you talk about a statement of financial position as you consolidate, you need to know that you are adding everything together for the subsidiary and the parent 100%. Now, very fast, the most important thing here, you start with the group structure. And let me just write here, this is the solution. This is the solution. So very first, let us start with the group structure. Now, when you talk about the group structure, we know that in consolidation, group consolidation falls under IFRS 10. And we know what IFRS 3 talks about is business combinations. Then IAS 28 is talking about investment in associates and joint ventures. So here we are combining all those IFRSs, the provisions that are given. And when we talk about the group structure in this our case here, I want to take you back to the start of the question. We are told Adani acquired 80% of ordinary share capital of Kenya Airways. Now, the group structure here, we are talking about Adani, and Adani owns 80% of share capital in KQ, Kenya Airways. That gives us a view of the group structure here. Then the same Adani has also acquired 40% of ordinary share capital of KPLC. So we talk about 40%. They've also bought 40% of the share capital of KPLC here. So how much did Adani pay to acquire Kenya Airways? According to what the question say, we are told for 160 million. So Adani paid 160 million. And then to acquire the 40% of KPLC, they paid 70 million. I believe, members, we are together there. I believe we've started together so that we understand. And I want you to be very keen, because most of these concepts, the most important thing is to understand. Once you've understood a concept, whichever way the examiner brings the question, you'll always pass. You'll always understand and find your way out. This is not a concept. This is not areas where you need to cram anything. No, just understand the concept. Now, I've started with the group structure, and you can see the group structure is there. 80%, and we know how the group structure works. In case, if an investor owns more than 50% shareholding in a company, let me just put it here. Now, whenever an investor owns more than 50%, we know that that investment where the investor owns more than 50% is a subsidiary. We know that's what qualifies to be a subsidiary. And where the investor only owns exactly 50%, if the investor owns exactly 50%, because this will bring me an answer. Let me put, yeah, something like that. If an investor owns exactly 50%, this one now is a joint venture. I believe these are concepts you've already covered, so you'll remember them. And what of where an investor owns between 20% to 49.99%. So let me talk about between 20% and 49.99%. What type of ownership do we call this one here? If an investor owns between 20% to 49.99%, that's when we talk about an associate. That is an associate. And I believe that is something also you know. But if an investor owns a shareholding, has a shareholding of less than 20%, this kind of business relationship is what we call a normal investment. This is just a normal investment, I believe these things you remember, and they're very important. Once you've known these matrices, it will always help you to come up with a group structure and know which one is a joint venture, which one is a subsidiary, which one is an associate, and which one is just acting as a normal investment. I believe we are together there. Now, in this our case, you realize that this Adani is holding 80% of Kenya Airways. Now it is very obvious. If you check on this percentage of shareholding we've given here, you realize that now Kenya Airways qualifies to be a subsidiary of Adani. So this Kenya Airways will be a subsidiary. So I will write here subsidiary because it is more than 50% according to what I've given you here. And if the same Adani is now having a shareholding of 40% in KPLC, if you refer here, you realize 40% is less than 50. So there is no way KPLC can be a subsidiary to Adani. No. And if you look at the second scenario of exactly 50% shareholding, 40% is less than 50. So KPLC is also not a joint venture. And when you look at the third category of between 20% to 49.99%, now you realize this is where KPLC falls. Adani holds 40%. 40% lies between 20 to 49.99. Now, what does that tell you? It tells you KPLC is now an associate. Is now an associate to Adani. I believe we understand that type, that categorization of the group structure. I believe we understand that. Now, another very important concept that I want you to remember, after coming up with that group structure, there are two very important things that you need to remember. That is date of acquisition and date of the financial statements. Very important. Date of acquisition and date of the financial statements. Very important. Now, I'll take you back to how the question was introduced. When was this acquisition, when did the acquisition happen? Adani acquired 80% of the share capital of Kenya Airways for 160 million. And 40% of the shareholding in KPLC for 70 million. Those ones have already recorded here, and you can see the summary here. Then they continue by saying the retained earnings were 64 million in Kenya Airways, and there were 24 million in KPLC. Adani and Kenya Airways and KPLC are public limited companies. Now, look at the date of acquisition. When was that? 1st of January 2017. That was the date when Adani acquired 80% in Kenya Airways and 40% in KPLC. So that means date of acquisition is 1st of January 2017, according to what we've been given there. Then, what is the date of financial statements? DOF stands for date of financial statements. Now, that one you can even get from required. Check on the required. Prepare a consolidated statement of financial position for Adani and its subsidiary as at 31st December 2019. That is the date of financial statements. So I'll write it there. 31st of December 2019. That is the date of the financial statements. Now, if you look at the dates between 1st of January 2017 to 31st of December 2019, what is the period? How many years between the two dates? So that you can see for how long did Adani trade with the Kenya Airways, and for how long did they trade with KPLC? Someone, 3 years. Good, thank you. I believe everyone understands why it is 3 years. I can see members there already getting it very easily. That is very nice. So they traded for 3 years. KPLC was a subsidiary for 3 years. Then again, Kenya Airways was a subsidiary for 3 years. Then KPLC, an associate, for also 3 years. That is very important. Now, what is the second step? Group structure is step 1. Step number 2 is to come and start doing a pro forma straight away. I'm giving you this step so that they can help you to maximize on your entries in an exam, and this will make you get the highest marks possible. It will maximize on your entries. Now, after coming up with a group structure like this one already you have enough to start with. The next thing is to go and do a pro forma consolidated statement of financial position. When I talk about a pro forma, what I mean is you do the format and you start doing your entries, but you don't get your final answers at that point. That's how we call it pro forma. But in case time cuts you short along the way, the advantage is you're dealing with Excel. Excel will automatically add will give you your summations automatically. So in case time cuts you short, you will not come out with a 0. You will get a good number of score. And this one, these are the low-hanging fruits that you need to make sure that you do not miss. Now, very fast, I want us to come and do this consolidated statement of financial position. And here I will go and say Adani Group, consolidated statement of financial position, like that. Adani Group statement, consolidated statement of financial position. And it is as at 31st of December 2019. I think that is the date of the financial statement which was given there. That is the date of the financial statement which was given there, like that. Now, after drawing that, after writing that title, very fast, let me do that. Very fast, let us do the pro forma statement of financial position. And we know how this one is drawn, guys. You've done preparation of financial statements with the Mr. Bura, and I believe this is something which is not a problem to any of you. So let's look at our figures are in millions, and they're in dollars, millions. But I will not put the currency. I will just work with millions to make our work easy. But you know the question is talking about dollars. So let me just write there millions, and I will put it like that so that we work with we don't have a lot of zeros in our figures. Let me do that like that. Let me do like that. Now, very fast, we want to start with the elements of the financial position, statement of the financial position, and we know we normally start with assets. And in an exam room, you don't even have to write the assets. You can just say non-current assets straight away. So long as you know after the non-current assets, you know what you go to, you come to the current assets, and so on and so forth. So I will straight away just write that. And then the non-current assets, I want you to go and look at this statement of financial position provided. We are doing a pro forma. Now, because in an exam room, we don't have time to even start reading the additional information fast. Work with the pro forma, exactly getting information from here. Already you have your group structure in place, and you know that Adani is the parent. Then Kenya Airways is the subsidiary, KPLC is the associate. And you know the rule of consolidation. You only consolidate a subsidiary. You only consolidate a subsidiary and the parent. Do not consolidate an associate. I say and I repeat, an associate, you do not consolidate. Only consolidate parent and the subsidiary. So for now, as we do the pro forma, please don't look at this column. This column here, let me highlight it. Please don't look at that. Leave it out. You only concentrate on the parent and the subsidiary for now, because that is what IFRS 10 tells us to do about consolidation. Now, very fast, I want us to check here and see the first non-current assets provided here is the PPE. I will pick the PPE directly like that, and I bring it here. So I can move this here like that. Now, the PPE in consolidation, you add 100% assets of the parent to 100% assets of the subsidiary, except when it comes to the part of equity, where you know that in equity, you only take the equity elements of the parent. Liabilities, you also add 100% of the parent and subsidiary. Very simple rules, which you cannot manage to forget, because these are where you can score your marks. Now, very fast, I will come here and pick the PPE for the parent. And after picking that, I add the PPE for the subsidiary, like that, just like that. I have my 380 here, 380 million. So this is a pro forma. You can either make your answer come out like that, which is safer for you in case time cuts you short. But if you want it to remain as a pro forma, you can introduce an apostrophe there before the equal sign, so that you do not have an answer, but you only have this reference of cells. But because we know what is in there and the work which is remaining, we do not have to leave it like that. Let's just have an answer there as we continue and we do our adjustments as we move on. Now, in the non-current assets category, we also have investments. Guys, I want you to be very careful here. When you talk about investments here, I want you to look at it and you will see that investment value is only under Adani, which is the parent. When you come to the subsidiary here, there is no investment given. And when it comes to KPLC here, there is no investment given. But I've told you to ignore this column here, because we don't consolidate an associate. We only consolidate a parent and the subsidiary. Now, this 230 million you can see under the parent, under Adani. This is the total investment that the parent put in for Kenya Airways and KPLC. If you add 160 million, which they paid to acquire 80% of Kenya Airways, and you add it to 70 million, which they paid to acquire KPLC. 160 plus 70 million is 230 million. That's why that is the 230 you can see under investments in Adani. I believe we are clear there. That's how they got the 230. Now, if the figure of investments under the parent was more than the total amount invested in subsidiary and the associate, then that will also qualify to be other investments. And when you're consolidating, you will only bring that investment other than the amount invested in subsidiary and associate. You will come here in the consolidated statement of financial position and introduce other investment or just the word investment, and you only bring out that figure which falls outside of the amount they paid for subsidiary and the associate. I believe you are getting that because that is a very important point. Now, and because our figure which is given here is exactly the total invested in KQ and KPLC, we do not have any other investment to the third party. We do not have it in this our case. So what does that mean? That means this investment which is written here, we are not going to consolidate because already this is the amount spent to buy the subsidiary and the associate. Now, investment in a subsidiary normally translates into something called goodwill. So that's why here we now bring in something called goodwill. And this goodwill, we will get it from a working. So I will just put a bracket there and say working. Investment in subsidiary is translated or maybe turns to be a goodwill. You don't have an investment subsidiary in the consolidated statement of financial position. Because when you acquire a subsidiary, now you are one company, you are a group. You do not still say, now this is another investment I did to this. Apana, you are in one group. Now, after that, we now come and ask ourselves, because we are not consolidating the associate, we will now introduce investment in associate because we are not consolidating it. Investment in associate, like that. And this investment in associate will also be a working. Will also be a working. Investment in associate, do not go ahead and just bring in the 70 million and say that this parent paid 70 million to acquire this associate. No, don't bring it there. I will tell you how we are going to calculate investment in associate. Those are computations. But because we're doing a pro forma, we are not computing at the moment. We are just harvesting the low-hanging fruits and putting them in like that. Now, let's go to the second category, and we know these ones are now current assets. Current assets there. And when we talk about the current assets, this is now a very simple part. I want you to refer to the statement given, and you can see our current assets are inventory, trade receivables, and cash at bank. I will just do a direct referencing very fast so that you don't waste time like that. Then after that, I can drag to the 3 cells to bring them over like that. Now, like I said, and what we did in PPE in the first part, you add 100% of these current assets of the parent plus the current assets of the subsidiary, but you do not add anything of the associate. So I've brought in the inventories, added the parent and the subsidiary. Let's do the same for trade receivables. Trade receivables, we are adding trade receivables of the parent to the trade receivables of the subsidiary, like that. We have our figures there. Then cash at bank, we do the same. You just add what the parent is bringing over, and then to what the subsidiary is bringing over. Very simple concepts. Tell me if this thing you can fail in an exam. No, you cannot. That's why you should not panic in an exam room, because these are very low-hanging fruits. Even if you cannot be able to interpret the additional information, you will not come out with a 0. There are a lot of marks you'll get here. And in consolidation, every correct entry earns you 2 marks. And in most cases, even if you do not finish doing the statement of consolidations, you'll be able to even score full marks, because the number of marks, if you do everything, will be more than the maximum you are able to score. So you should not even worry about anything. These things are very easy, and you will pass. Now, we are through with the current assets. Let us come to equity and liabilities. Equity and liabilities. And we start with the equity. I mentioned just a few minutes ago that when consolidating the statement of financial position, equity elements, you only pick equity elements of the parent. Do not pick equity elements of the subsidiary. You are only doing equity elements of the parent. So that's what I will do. Let me just refer like that. And we have ordinary share capital, we have retained earnings, and we have the share premium like that. So I will only pick equity elements of the parent. Do not touch anything of the subsidiary. Associate is out of question. That one, you don't even look at that column. We highlighted it with a yellow. Yellow color is very conspicuous. So do not even look at that column like that. So I've only brought equity elements of the parent. I've not touched on the equity elements of the subsidiary. Have I brought for them for the subsidiary or the parent? Let me see. No. I must have picked wrong ones. I need to pick only for the parent. Where is it? For the parent starts with 400. Yes, like that. Good. No. Why is it repeating? Why is it bringing me 400, 400? The next one should be 16 and 278. Correct. Good. Good, good. Now, Mwalimu, you've I think you meant I picked for the subsidiary. Good. I know, I noticed that. Thank you. So after picking the equity elements of the parent only, we move to the next stage. And these ones now are the liabilities. And if you look at the statement given here, you realize that we do not have non-current liabilities. We only have current liabilities. So we do not have to put in what is not there. So I will only pick the current liabilities which we've been given, like that. And current liabilities, which is given here. Let me just type it, current liabilities. And this is trade receivables.